Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined today by George Goncalves, MUFG's Head of U.S. Macro Strategy. It's Monday, May 14th, 2024. Welcome back to the podcast, George.
Great to be on as always, John.
Yeah, good to have you. And it's been a while. It's been a bit since your last episode, and I think with good reason. You've as I know, you've been very busy traveling to visit clients all around the U.S. Actually all around the world. When I think of it, why don't we start there? I think our listeners would be interested in hearing what sort of the collective view is from the buy side on the economy, the Fed, and markets, or the differences in opinions among different investor types, that sort of thing. Why don't we start there?
Yeah, that's a great place, and I'll try to look through these sort of views and interactions that we had in comparison to how it relates to our house view and what we both learned, as well as how perhaps views have changed along the way. But in short, if I had a word cloud, if you can envision a word cloud of just different topics that are typically discussed, I would say the one kind of phrase or expression that comes around more often, you would probably see a big low conviction in the middle of this big word cloud of Fed, rates, markets, economy, labor, those infamous word clouds. I would say that the thing that really stands out is just a general kind of confusion around where we are in the cycle, both for Fed, the economy, just markets. Having said all that, of course, markets are always evolving and reacting to the data. In many ways, we should expect this because this is a world that's clearly data dependent until we get more of a trend, either in inflation or labor data, or if something were to happen, financially, it takes us in a different direction. But I would think like low conviction is really what stands out the most. And I think that also comes across in the way price action has behaved lately. We get some new information. For example, we can use the example of labor data. And as well as those that read and are followers of our work, that we've been well ahead and have been focused on the kind of cracks under the surface for the jobs data, which we think have been forming for the last 6 to 9 months, and now they're starting to come to the surface, or at least the last NFP that we had did kind of call into question how resilient, how robust labor market really is. And I think many of the clients are starting to kind of really zoom in on that. And I think that was probably the biggest change that I picked up on, that just like the Fed is focusing on balance of risks between labor and inflation, a lot of the investors out there are slowly pivoting towards what would it take on the labor front to really change the Fed's reaction function. So I think that was interesting. I mean, in many ways, coming around to some of the views that we've had. Now, granted, I mean, many investors have actually, flagged and rightly so that perhaps I was a little bit too early. We were too early in overemphasizing the labor side because inflation was sticky, and therefore rates had priced in too much cuts. So it did make sense, for those investors that were actually fading the rate cuts earlier in the year, and they got that trade right. And the ones that did and were open about it. We're also slowly kind of coming around to the idea that perhaps, at least tactically speaking, it's much more of a asymmetrical kind of world now, that it's hard for rates to go like terribly higher, at least in the front end, considering that Chair Powell pushed back that they're not looking at hiking. They would be more likely on hold for longer or cutting. So I would say I think that's probably the big takeaways, in terms of those that share my view and don't share my view. I still think it comes down to a 1/3 kind of agree with the macro thesis that I have. That this has been a cycle that's been elongated by fiscal policy, and that it's not really sustainable without it, and that the consumer is running out of steam, and that really what's left is just the labor market giving way. I would say there's a growing chorus around that, and those coming along to our view, but I think the majority still think that maybe perhaps if fiscal hasn't fully worked its way through the economy, and it's going to be there for longer, and therefore it's going to be hard to see a slowdown happening, especially during an election year. So, yeah, I would say it's like still that 1/3, 2/3 kind of split.
Okay, well, for that one third, there's certainly some value out there. 2 year notes. Obviously, you'd prefer to buy them at closer to 5%, but good value here at 482 if you subscribe to George's view. And as a reminder to our listeners, we're recording today's podcast on Tuesday, May 14th. That's just one day ahead of the release of the always critical CPI report. George, why don't you take our listeners through what to watch for in the report? I'd be particularly interested in how the markets might react. Like, as example, if like CPI prints a donut and you get like a 0 month over month on headline or a 0 month over month on core, like how does the market react to that versus like an above consensus print? And then maybe if we could back up just a second or zoom out perhaps. I'm also curious where we are in the process of heading towards the Fed's 2% inflation target more generally.
Sure. First, before we discuss CPI, we all know, and it bears reminding that the Fed targets core PCE and not necessarily CPI. But CPI is very instructive on just general price dynamics and what's happening on the inflation front. And of course, it's what markets focus on in the middle of the month. So we have to watch for it. What's interesting about at least this month's release for the April data, we had a switcheroo between PPI was released first before CPI, and perhaps maybe PPI stole some of the thunder of the CPI release, although markets kind of saw through the uptick in the slightly hotter PPI because of the adjustments or the revisions to the back month. But nonetheless, this might create an interesting dynamic as we head into the CPI report. You asked for a scenario analysis. I'll do the best I can on the fly to kind of think through what could be the market's response to various gradations of consensus versus missing consensus, either up or down. I mean, the estimates according to Bloomberg is like 0.4, I think, for the headline and 0.3 for the core. That would be a slight moderation, at least for the core side, especially. And I think it would really require a much larger number, like a zero point 0.5, I think. I mean, if it's a zero point 0.4 again, then yes, market's going to react with a surprise to the downside. Rates will be rising. Rates would most likely rise in a bear flattening sort of context. Risk markets most likely would not like that. I mean, that would be a case of bad news is bad news. So any sort of upside surprise on inflation, especially on the core side, I'm kind of ignoring the headline a little bit because energy prices have had a big move in the beginning of the month of April, but then started to stabilize. There might be some catch up there, but if we put headline aside and just focus on the core, a 0.3, I think the market will probably rally because it's still coming down from the roughly like a zero point 0.4 average for Q1, and Q1 is really what called into question this gentle decline, which was looking like it was the case that at some point the Fed would have gotten down to its 2% target in 2024, but the bump up during Q1 has called into question, like, are they going to be able to hit 2%? How long is it going to take? The Fed uses the concept that they need greater confidence, and in Q1 clearly derailed that confidence. And so it's also pushed back the cuts deeper into the end of the year. If we got a 0.3, and especially if we got like a 0.25, like a rounded up 0.3, I think the market would have continue on the rally that we've seen, which again, the concept which we are kind of subscribing to is that the jobs data, maybe we were early in flagging some of these risks, but they're starting to come to the surface. And so there was a huge catch up that had to happen in the jobs data. And if it continues to weaken, then our thesis will be proven correct. Now, if the same thing is true for inflation, there's a lot that's still unresolved when it comes to the owner's equivalent rent and the lags of the feed through from rental inflation, which has been declining for 15 to 18 months and hasn't really declined enough in the actual measures of inflation. So if there's a huge catch up, let's say at the next 3 to 4 months, we get all of the core adjustment lower because owner's equivalent rent has a huge level shift lower, and if it starts this actual report, then it keeps the July cut in play, right? So we have a July cut, as you know, and it's in those that read our work. So it really would be in line with our view that the data has been lagging the reality on the ground, both for the jobs market and this owner's equivalent rent. And if it were to fed through quickly and have a huge catch up, then I think markets would really rally. So, and then anything under 0.2, it's just you kind of just have to just kind of amplify the sort of rally. So we've had a big move. We've had rates come down about 25, 30 basis points from the local highs on various points of the curve. It would have to be a 0.25 rounded up and or under that to get another like 5 to at least 10 basis points easily lower in rates.
Yeah, very interesting. So to summarize, higher core, curve bear flattens, but stocks sell off. So there could be some, perhaps, that could perhaps ultimately, put a bid back into the market there. Consensus core, you get some sort of like relief rally, sort of assuages the fears of the market over the stubbornness of inflation in Q1 so far this year. And clearly you get a rally if it's softer, presumably, and I don't know if you said this, but presumably stocks would like that too, right, George?
Yeah, I think, look, if it's a catch up because of the owner's equivalent rent, this would then legitimize the idea of the immaculate disinflation, that inflation's still eventually going to get to the Fed's target, and they can normalize rates without having to do emergency cuts later in the future, or just have to really play catch up later on. So if the Fed is able to actually normalize policy instead of having to cut rates for other reasons, I think that would be beneficial for risk assets.
Yep, for sure. And yeah, and very interesting to think about that if a catch up in shelter inflation, materialized either, tomorrow, you could really start to see some of these, like as you said, you are still calling for a July cut, and it's only priced 8 basis points right now, but all of a sudden that the path to the July cut becomes a lot clearer. So great stuff as always, George. Really looking forward to seeing how the CPI plays out. Thanks again for joining us.
Thanks for having me, John.
And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.